Here's something that will challenge everything you think you know about investing. The average person who invests in ETFs outperforms 90% of professional fund managers. Yet most people are still terrified to start because they think investing in ETFs is too complicated, too risky, or requires too much money. The truth? ETF investing in 2026 is simpler than ordering food on your phone, safer than keeping money in a savings account that's losing to inflation, and you can start with as little as $1. But the financial industry doesn't want you to know this because simple, low-cost investing doesn't make them rich. It makes you rich. Give me 15 minutes and I'll demystify ETF investing for you. Let's get started. What you're about to learn will completely change how you think about building wealth. Because ETF investing isn't just for Wall Street professionals or people with trust funds. It's one of the most powerful wealth-building tools available to ordinary people, and by the end of this video, you'll know exactly how to use it. Before diving into the how-to, you need to understand what makes ETFs so revolutionary and why they've become the weapon of choice for smart investors worldwide. ETF stands for Exchange Traded Fund, but that technical definition doesn't capture their true power. Think of an ETF as a basket that holds hundreds or thousands of different investments, stocks, bonds, commodities, or real estate, all wrapped up in a single package that trades like a stock. When you buy one share of an ETF, you're instantly buying a piece of every investment inside that basket. This simple concept has created a financial revolution. In 1993, there were only a handful of ETFs, managing a few $billion. Today, there are over 8,000 ETFs worldwide managing more than $10 trillion. That's not just growth, that's a complete transformation of how people invest. But here's what most people don't understand about this revolution. ETFs have democratized investing in ways that were impossible just 20 years ago. Strategies that were once available only to millionaires and institutions are now accessible to anyone with a smartphone and a few dollars. Even better? The expense ratio war among ETF providers has driven costs to near zero. Many broad market ETFs now charge less than 0.03% annually. That means for every $10,000 invested, you pay just $3 per year in fees. Compare that to actively managed mutual funds that often charge 1 to 2% annually, and the difference compounds to hundreds of thousands of dollars over a lifetime. A single ETF can provide exposure to thousands of companies across dozens of countries and multiple asset classes. VTI, the Vanguard Total Stock Market ETF, gives you ownership in over 4,000 US companies with one purchase. VXUS provides exposure to over 7,000 international companies. This level of diversification would have been impossible for individual investors to achieve cost-effectively in the past. ETFs are also structured in ways that make them more tax-efficient than mutual funds. They rarely distribute capital gains to shareholders, which means you keep more of your returns instead of paying unnecessary taxes. This tax efficiency can add 0.5 to 1% to your annual returns compared to similar mutual funds. Unlike mutual funds that only trade once per day after markets close, ETFs trade throughout market hours just like stocks. This means you can buy or sell whenever markets are open, giving you complete control over your investment timing. ETFs publish their holdings daily, so you always know exactly what you own. There are no surprises, no hidden investments, and no style drift. This transparency allows you to build precise portfolios that match your investment goals. Now that you understand why ETFs are so powerful, let's walk through the exact process of becoming an ETF investor in 2026. Step 1. Choose your brokerage platform. The first decision is where to open your investment account. In 2026, the best brokerages offer commission-free ETF trading, which means you pay nothing to buy or sell ETFs. Some top platforms include Fidelity, Schwab, Vanguard, and Interactive Brokers. The key factors to consider when choosing a brokerage are zero commission ETF trading, low or no account minimums, fractional share availability, user-friendly platform, and strong customer support. Step 2. Determine your investment goals and timeline. Before buying any ETFs, you need clarity on what you're investing for and when you'll need the money. This determines your asset allocation and risk tolerance. For retirement investing with 20-plus year timelines, aggressive growth portfolios with 80 to 100% stock ETFs makes sense. The long timeline allows you to ride out market volatility while maximizing growth potential. For medium-term goals like buying a house in 5 to 10 years, balanced portfolios with 60 to 70% stocks and 30 to 40% bonds provide growth while reducing volatility. For short-term goals under 5 years, conservative portfolios with higher bond allocations or even high-yield savings accounts may be more appropriate than ETFs. Your age also matters. The traditional rule of thumb is to subtract your age from 110 to determine your stock allocation. A 30-year-old might hold 80% stocks, while a 60-year-old might hold 50% stocks. Step 3. Master the core ETF categories. Understanding the main types of ETFs helps you build a well-rounded portfolio that matches your goals. Broad market ETFs provide exposure to entire stock markets. VTI covers the total US stock market, while VT covers global stocks including the US. These are perfect core holdings that provide instant diversification. International ETFs add geographic diversification beyond the US. VXUS covers developed and emerging international markets, while VEA focuses on developed markets and VWO targets emerging markets. Bond ETFs provide stability and income. BND covers the total US bond market, while VGIT focuses on intermediate-term government bonds. These help reduce portfolio volatility. Sector ETFs allow targeted exposure to specific industries. XLK focuses on technology, XLF on financials, and XLE on energy. These should be used sparingly as satellite holdings. Factor ETFs target specific investment styles. VTV focuses on value stocks, VUG on growth stocks, and VB on small cap stocks. These allow fine-tuning of your equity exposure. Dividend ETFs focus on income-generating stocks. VYM targets high-dividend stocks, while SCHD focuses on dividend growth companies. These are popular with income-focused investors. Step 4. Build your portfolio allocation. The most successful ETF investors use simple, low-maintenance portfolios rather than complex strategies with dozens of funds. Here are proven allocation models. The 3-fund portfolio consists of 60% US stocks with VTI, 30% international stocks with VXUS, and 10% bonds with BND. This provides global diversification with minimal complexity. The 2-fund portfolio uses 70% total world stocks with VT and 30% bonds with BND. This is even simpler while maintaining global diversification. The target date approach uses a single target date fund that automatically adjusts allocation as you age. Vanguard's target date funds are excellent one-fund solutions. The aggressive growth portfolio might use 70% US stocks with VTI, 20% international stocks with VXUS, and 10% emerging markets with VWO for younger investors seeking maximum growth. The key is choosing an allocation you can stick with through market ups and downs. Simple portfolios are easier to maintain and rebalance. Step 5. Implement dollar-cost averaging. Rather than trying to time the market, successful ETF investors use dollar-cost averaging, investing a fixed amount regularly regardless of market conditions. This strategy reduces the impact of market volatility and removes emotion from investing decisions. Set up automatic investments of $500, $1,000, or whatever amount fits your budget to purchase your chosen ETFs monthly. This automation ensures consistent investing and takes advantage of market fluctuations by buying more shares when prices are low and fewer when prices are high. Most brokerages allow you to set up automatic investments that will purchase your ETFs on the same day each month. This set it and forget it approach is perfect for long-term wealth building. Step 6. Understand rebalancing. Over time, your portfolio will drift from your target allocation as different assets perform differently. If stocks outperform bonds, your portfolio might shift from 70-30 stocks to bonds to 80-20. Rebalancing brings it back to your target allocation. Rebalance annually or when any asset class deviates more than 5% from its target. This forces you to sell high-performing assets and buy underperforming ones, which is the essence of buying low and selling high. Many target date funds automatically rebalance, which is another advantage of these simple solutions. Once you've mastered the basics, several advanced strategies can enhance your ETF investing. Tax loss harvesting involves selling losing investments to offset gains and reduce taxes. Many brokerages now offer automated tax loss harvesting services that can add 0.5 to 1% to your annual returns. Asset location means holding tax-inefficient investments in tax-advantaged accounts and tax-efficient investments in taxable accounts. ETFs are generally tax-efficient and work well in taxable accounts. Factor tilting involves overweighting certain factors like value or small cap stocks that have historically provided higher returns. This requires more sophistication but can potentially enhance long-term returns. International currency hedging protects against currency fluctuations when investing internationally. Hedged ETFs, like HEDJ, provide international exposure while reducing the impact of currency fluctuations on returns. Even with their simplicity, investors make costly mistakes that can derail their success. Over-diversification happens when investors buy too many overlapping funds. Owning 15 different US stock exchange-traded funds doesn't provide more diversification than owning one broad market fund. Chasing performance leads investors to constantly switch between hot-performing ETFs. This market timing rarely works and often results in buying high and selling low. Ignoring expense ratios can cost thousands over time. Always compare expense ratios when choosing between similar funds. A difference of 0.5% annually compounds to significant amounts over decades. Emotional trading causes investors to panic sell during market downturns or get greedy during bull markets. Successful ETF investing requires discipline and long-term thinking. Neglecting tax-advantaged accounts means missing out on tax benefits. Always maximize 401k matches and IRA contributions before investing in taxable accounts. The ETF industry continues evolving rapidly, with new innovations that benefit investors. Here are a few. Fractional shares allow you to buy partial shares of expensive ETFs, making diversification accessible with small amounts of money. Zero-fee trading has become standard, eliminating transaction costs that once made small, regular investments impractical. Thematic ETFs provide exposure to trends like artificial intelligence, clean energy, and cybersecurity, though these should be used sparingly. ESG ETFs focus on environmental, social, and governance factors for investors who want their investments to align with their values. Cryptocurrency ETFs now provide regulated exposure to Bitcoin and other digital assets for investors seeking alternative investments. ETF investing in 2026 represents the most accessible, cost-effective, and powerful way for ordinary people to build extraordinary wealth. The barriers that once prevented regular investors from accessing sophisticated investment strategies have been completely eliminated. You don't need to be a financial expert, you don't need thousands of dollars to start, and you don't need to spend hours researching individual stocks. With ETFs, you can build a globally diversified portfolio that outperforms most professional investors with just a few simple funds and a disciplined approach. The most important step is the first one. Every day you delay starting is another day of potential compound growth lost forever. The difference between starting today and starting next year could be tens of thousands of dollars over your investing lifetime. The tools, platforms, and ETFs are all available right now. The only thing standing between you and financial independence is the decision to start. Your future self will thank you for taking action today. What's holding you back from starting your ETF investing journey? Is it fear, confusion, or just not knowing where to begin? Drop your biggest concern in the comments, and let's address the obstacles that are keeping you from building wealth. If this breakdown demystified ETF investing, hit that subscribe button for more practical wealth-building strategies that actually work in the real world. We publish fresh content weekly. And learn more by watching another video on our channel, The Ultimate Guide to Choosing the Best ETFs in 2026. See you on the next one.